Good morning. It is Friday, October 19th, 2018, the day that the Brewers will tie the National League Championship Series with the Los Angeles Dodgers at 3 games apiece, and the day before the Milwaukee Brewers will advance to the World Series. There you go. Got that out of the way. So let's do a little quick review from the fourth quarter macro and market outlook. I had talked about how earnings would catch a rough patch as companies announced some lower revised estimates due to trade concerns. That has started to happen. I also talked about how the buybacks would pause, and that would cause some stock market volatility, which we have seen. There's been a lot of talking heads out there trying to say, well, it's the trade, well, it's the Fed, well, it's this, well, it's that, well, it's oil, it's everything. It's not. It's not everything. It is the buybacks. The buybacks are in their lull period right now, and that lasts about another week to 2 weeks. Once that is over, you'll see up to $300-400 billion into the market over the last couple of months of the year. That will be one of the largest buybacks in a condensed period ever. I think it actually will be the most buybacks ever made in a 2-month period. So we talked about how the economy is doing well, but there's still underlying weakness. As I have gone through before, I've driven all over this country. I've looked at it from the ground up, and we really still have major holes in the economy. There are a lot of people, 20, 30% of the population, that should be in the workforce that are not. Combination of they don't want to they don't have the training. They call it being discouraged, but they don't show up on the unemployment rolls. So when we take a look at folks who probably should be in the workforce, right? I mean, they're not independently wealthy, so they shouldn't be sitting out. We need to mute everybody. There we go. And they really ought to be moving back into the workforce, but they don't want to take $10 and $12 an hour jobs, so they don't. They end up on social services. They end up angry. They end up frustrated. We really have to fix that in the long run, quickly. So for the long run, but quickly. Otherwise, the next recession will make a lot of people even angrier than they were the last time. Because we'll, of course, do bailouts again. They'll say, hey, you're not bailing me out, whether or not we are. We need to train these people. We need to give them financial support to get rolling. And, hopefully that would do the trick. I frankly don't think we do it very seriously. I was just at a Starbucks near Marquette University. There was a homeless man in there, and everybody just kept their head down to talk to him. He was asking for some money to buy something to eat. I ended up buying him something to eat. He still was, clearly mentally disturbed, and ended up being a scene, him and the manager of the Starbucks. The reason I bring that up is because those are the sorts of folks that we need to just help to be helping. He's not going to ever get a job, but there are millions and millions of people out there that are employable, that we have to figure out a way of getting them into the workforce so that they're not taking as much benefits. And maybe they still get partial benefits, but they wouldn't be 100% reliant on the government. There has to be some creative, smart ways to handle this, because otherwise it's going to be very bad for the economy. And I bring this up over and over again because it's knocking on the door. Whenever this Fed decides that they want to cause a recession, and I'm almost of the opinion that they want to cause a recession in a couple of years, because the United States does very well in relative terms during crisis. I think that might be what they're angling for. There's about $7 or $8 trillion of debt that the United States has to roll over in the next few years. How are they going to do it? If everybody has to have dollars because they're scared, they'll buy U.S. Treasuries. So we need to keep an eye on what's going on with the Fed. I think there's a better way to do it than causing a crisis, but they don't want to listen to me. So we'll see what happens down the road. But there are certainly underlying cracks in the economy. The list is very long, from bubble growth in certain asset classes to complete misconceptions about inflation and deflation, which we're going to actually touch on a little bit today. Um, and we really are at the precipice of the economy turning over to the negative versus accelerating upwards. And that's too bad because we have enough money in the economy, right? Enough of the QE money still out there that if we put it into action, we would do very well. I don't believe it was this article, maybe it was, but I put up a chart about velocity of money. And I think I just posted it on its own. But I had a chart about velocity of money, and it showed that the velocity of money has just fallen off a cliff the last several years. So there's money out there, it's not moving, and this is one of the reasons why millennials in particular, and even those younger, rail about capitalism. Oh, capitalism isn't doing what it's supposed to. Well, we have a series of bad policies relating to taxes and regulations that are stunting basically capital turning over, right? Capitalism is about capital being in the system and it keeps moving. And the money's not moving right now, right? It's hoarded into fewer and fewer hands. It's not moving into the general economy. The tax cuts for the richest people is just a stupid idea that is not going to actually trickle down. It just adds to the pile of gold that the dragons are guarding with their lives. What there should be is intelligent tax policy that basically says something along these lines. You figure out how to write the law, but the tax policy should basically be, hey, if you're working, we're going to help you out, give you a couple bucks off. See, the middle class tax cuts were great. They actually were deserved. Hardworking people could use the money, and it does get filtered right back into the economy, like 80 to 90% of it. It might even be more. But the wealthy, the one percenters who got the majority of the tax breaks, that money is not filtering into the economy. We know that the corporate tax breaks are going like 70, 80% into dividends and buybacks, right? And that basically benefits the richest people in the country again. And we know that the tax cuts from 39.6% for the upper tax bracket down to 37%, that just goes into their pile of gold as well. So how does that help capital get recycled? It doesn't. Tax breaks for the wealthy and for corporations should have been tied to capex spending, should have been tied to R&D, should have been, tied to a lot of things. There should be strings attached. Hey, we'll give you this tax break, but you got to put that money back into the economy. You just don't hoard it. And unfortunately, we're about to learn that lesson for the third time. We learned it in the 80s. We learned it under George W. Bush. We're going to learn it under President Trump. And we're going to blame it on something else because, hey, our ideology is more important to us than hey, we failed it 3 times to trickle down, because that's what's going to happen in the next few years. And the Federal Reserve is probably going to make it worse because, as I've railed on Chairman Powell a number of times, he either doesn't understand that deflation is the boogeyman, not inflation, right? Everybody needs to wrap that around their head, is that deflation is the boogeyman, not inflation. We have demographics and global debt and technology change that are causing deflation to be persistent and to keep inflation rates down in the face of roughly doubling the global money supply in the last decade, right? So we have global money supply growth evened out of around 7%, but inflation rates are at 2%. How do you explain that 5% gap? There is major downward pressure on the economy because of the aging of the American population, the Japanese population, the Chinese population, and the European population. What are those 4 economies? They're the 4 biggest in the world, accounting for, I don't know, it's like 80-some% of global GDP between Europe, China, Japan, and the United States. So as those economies get older, as the aging continues, and it will continue for decades, there's going to be major deflationary headwinds. And the only way to deal with these things is, frankly, to listen to guys like Larry Summers, who you may not like the fact that he's a Democrat. Oh my gosh. Well, fine. Then listen to Neil Kashkari. He's a Republican, and he's saying the same damn thing as Larry Summers. Get over the politics. The reality is that we have deflationary pressures, and that, going to an investment theme, is why I'm not really excited about buying leaps right now. Right? We are not at a low spot in the economy. We haven't had a gigantic sell-off. 1%, 2%, 3% we're getting, and people get all breathy on TV. Oh my God, the market's plunging 1.2%. How stupid does that really sound? Right? I know there's people in the investment services that get all breathy because, the market's down 2%. It's falling off a cliff 3%. Oh my God, that's nothing. That's nothing. When this market tips over, and it will eventually, you're going to see 10% drops in 1 or 2 days. That's what's going to happen. It'll be an elevator shaft drop. Why? I've shown the graphics before. The underlying strength in the economy is gone when the foreigners aren't buying, when there's less QE money, which there is. It's being held by the corporations and the very wealthy right now. It's not flowing into the general economy at all. And when interest rates go up and the Federal Reserve, and really the Federal Reserve might be the most important of all of these, is in a tightening posture. So I know that people try to say, well, we should have normalized interest rates. What is normalized interest rates? If we know that there's deflationary pressure, and we do know this, then what should be the neutral rate, right? The neutral rate means the interest rate that doesn't cause a decline in economic activity, right? The highest interest rate you can have without causing a decline in economic activity. Neil Kashkari, Minneapolis Fed president, and guys like Jeffrey Gundlach, Gundlach's kind of slightly different take, so I'll take that back. But Kashkari is saying we're basically at the neutral rate. I agree with him. There's several others out there with Federal Reserve credentials saying the same thing. Right now, the Federal Reserve is not unanimous about what we should be doing. But we've got Chairman Powell pushing for higher and higher interest rates, and that is not only causing the dollar to remain pretty strong, but it's crushing a lot of economies around the world. So with the United States having the strong dollar, but most of our assets overvalued, or at least fairly valued, but fairly to overvalued, we really need to think about, where do stock prices go over the next few years? Where do commodity prices go? Where does the dollar go? And I will say, without a crisis, the dollar probably starts to turn over in the next year or so. Now, I say this as the guy who in 2012 said the dollar was going to go on a prolonged bull market. And I laid out all the reasons why the dollar was strong. So if you go back and find an article titled Strength Beyond the Balance Sheet, look at that. It's the top one that pops up. I think that's because it's my Google. Oh, Strength Beyond the Balance Sheet. Let's put this guy's name at the end of it. Dollar strength beyond the balance sheet. There you go. Right, go back to all the way 2012, and everybody was talking about the dollar was just going to take a dump. And I told everybody the dollar was going to do pretty darn well. How well? Let's take a look at the dollar index. And we'll just look at UUP for simplicity. So this is where we were in 2012, and people said the dollar was going to fall off a cliff. And it's higher. Right? It's a dollar. It's not supposed to move a lot. And it's higher. Hasn't fallen off a cliff. Now, are we going to see more of the waviness? I think probably. You see the dollar is going to have to get a little bit weaker at some point. And that's going to mean that the Fed's going to have to lay off. I just don't see Fed Chairman Powell laying off until it's probably too late. The one thing that President Trump really has right, in my opinion, is the United States needs low interest rates. This idea that 4, 5, 6% is in any way healthy is wrong. The deflationary pressures of demographics and overhanging debt and technological change are a big deal. The way to stimulate the economy the right way is to really start moving towards a sustainable economy. And there's a lot of literature out there about that that makes it very clear that we can recycle a lot of capital. We can get a lot of capital back into the system. We get money velocity back up. We can offset the deflation if we just start moving to a sustainable economy. The problem is that President Trump does not want to do that. As we have learned now, President Trump is talking about slowing the sulfur, the new IMO regulations, and continuing to pollute more and more, of the environment. It's just, frankly, it's patently stupid. President Trump and some of his key people believe that it is stimulative to the economy to keep being tied to dying industries. That doesn't make sense. Oil and coal are going away. How long will it take? I don't know, a couple decades. But stretching it out and investing more into those industries when we can produce electricity, right, for the same price or cheaper with solar and batteries. I mean, we're at that point right now where we can do it. Given a choice, when you need new energy, right, not to replace existing energy, but when you say we need more kilowatts, it is cheaper to build solar in like 2/3 of the country than it is coal. Now, when you tell the coal utilities that they have to also clean up after themselves, which we've never told them to do, they just bury stuff, and then you get sludge dam breaks, and we had a bunch of sludge fall into Lake Michigan up here. There was a town that basically was inundated with the coal ash. Look, once the environmental impact of coal is taken into account, and we don't have to penalize them, we just have to say clean your own room, right? You tell your kid to clean your room, tell the coal plants to clean their room. If they actually had to clean up after themselves, coal would be the most expensive form of energy. But we give them a pass. That's called a negative externality. It means that they're able to push the cost onto the public. And that's what they've been doing for decades. And now we find out that there's probably some environmental ramifications to that. We probably knew 30, 40, 50 years ago. We might have known from day one. We might have known in the 1800s, right? Pollution's pollution. So if we don't start moving to a more sustainable economy, then what is going to happen? I've got the hashtag crash 2020, right? So if you just put it into your browser, hashtag crash 2020, you'll get my big round head all over the place. Just all over the place. A couple other people are picking it up now. Yeah, that's good. Crash 2020. Why crash 2020? A couple of reasons. First of all, if the Fed doesn't discontinue its tightening posture, that's probably enough to turn the economy over by 2020. But we also have a problem with oil, and oil has always corresponded to recessions, something like 85, 90% of the time. And we know that oil is not really in abundance. Now, we claim that it is, but it's not. If you go to any oil basin, and we're going to transfer here to oil here a second because we have some important things to think about here. Oil cracked the 100 million barrels per day mark recently. And that's both on supply and demand. So we know that the demand for oil is going up about 1.5 million barrels per day per year. And this idea that we can keep pumping another 1.5 million barrels per day per year indefinitely is wrong. We already know that with the exception of the Stack Scoop in Oklahoma and the Permian Basin in Texas, virtually all the other basins are running into physical constraints. Why is that? It's because a horizontally drilled fracked well is not the same as the old school vertical wells that were deep into an oil play, and they would pump out, you know, gently declining amounts of oil for decades. The new wells, and I think most of you know this, but if you don't, we'll throw it out there again, is that in the first 2 years, about 70-ish% of the oil that a fracked well will ever pump is out. So the holes from 2 years ago aren't producing very much. So you got to keep on drilling and keep on drilling and keep on drilling. Well, as you do that, you get away from the high graded parts of the oil plays. That is, you're moving to less and less affordable oil. You start with the cheapest oil and you move outward to the less cheap oil. And with the exception of the Permian and the Stack Scoop, there isn't much high grading left to do. So if we know that we're going to the more expensive parts of the Gulf of Mexico, if we're going to the more expensive parts of really any deep water out there, and this is why deep water's got a problem. And we know that the fracking is already starting to run its course. The EIA is saying that by the early to middle 2020s, oil production in the United States is going to turn downward again already, right? That's only 3, 4, 5 years away. So when does the market adjust to this? When does the price of oil go up even further? Now, when oil was in the 30s and 40s, I said, look, it's going into the 60s, 70s, probably 80s. And we're almost there. Brent is around 80. WTI is around 70. It might be a little bit lower today, right? Handy dandy charts. Handy dandy. Spot price oil, 71.84. And, so people get all bent out of shape over these little declines, right? They don't think about this, right? It bottomed out all the way back in 2016. It's been a steady drift upwards. And I've told subscribers that if oil gets back into the low 60s, and it could even be the mid 60s, but low to mid 60s, those will be spots to actually buy physical oil again. We were in physical oil for, from here and from here and from here, up here to up here. Those were some pretty good trades. And I don't like to trade. I really don't. I want the world to be easy. I want to just buy something and then go play poker and watch baseball and let my investments go up. The problem is we're near the end of an economic cycle, and there has to be a little bit more ebb and flow trading. Last week, what did we do? Last week, we bought the QQQ almost right at the bottom, right? So QQQ, we got at 169 right there that day. How's that for a good entry point? We invested right there. A low on the day was 167.81. We got in at 169. And it's up just a little bit. And it might bounce off of this 200-day moving average again. And I think it probably will. So what happens at the end of the year? Well, what we know, and so let's pull out one of our handy dandy tools. Click on our spreadsheets, right? See how I did that? People have been asking me to do this. There you go. VSLs for very short list. These are spreadsheets and all kinds of stuff. And for whatever reason, I'm getting a data and error data. Rich, I saw that you sent me some emails. I haven't read them yet, but we'll get this fixed. Probably have to pay for something, and that's fine. I don't mind that at all. So we have our targeted investments, our focused dividend, focused growth. But then I put in a worksheet, right? So, and I was just playing with it. If I put color somewhere, then you try to figure out what that means, right? This is a buyback worksheet. This is all the companies in the S&P 500 that have a corporate buyback going on. not quite half of the S&P 500, but darn close to half of the S&P 500 has a corporate buyback going on. Now, what are the companies that dominate the buybacks? All right. So, sort this. Stock buybacks. Just do like quarterly. Z-Day. Yeah. What do we see? Who are the companies that have the most in buybacks? Just look at the symbols. If it has 4 letters, what is it? It's NASDAQ, Apple, Oracle, AbbVie, Cisco, Broadcom, Intel, Celgene. Facebook is actually NASDAQ. They only have 2. Amgen, Biogen. Walgreens is actually NASDAQ now too, I believe. Microsoft, Google, which I call Google Bet, Charter. Verizon might be NASDAQ. I have to double check. Is NASDAQ, is Verizon, not Verizon, Visa, is Visa NASDAQ? I don't remember. But look, okay, so we know that the biggest buybacks are coming from NASDAQ companies. So what's the easiest thing to do? Buy the NASDAQ. Because in the fourth quarter, as soon as these earnings are done, the buyback blackout, it's not really a blackout, it's more of a gray out. Companies are allowed to buy back stock during earnings as long as it was prearranged, but they can't make discretionary purchases on top of that. They have to wait until after earnings to do anything that's discretionary, that's not pre-planned, right, through a program. So the buybacks are going to pick up. Who says so? Well, I've been saying so for a while, right? We talked about it here. In the forecast, we talked about it. Buybacks. Key's been a key theme. I wrote that silly article that the buyback bubble will end badly, but not yet, right? So you might want to click on that. What did I say? Was this 2 days ago? I said get almost fully invested soon. And sure enough, the 17th and 18th were pretty crummy days in the market, right? If you had bought yesterday, you'd already be up today. So we talked about asset allocation, the membership. Overweight, underweight. You know, what are you going to do? If you buy the S&P 500, you own all of that. I've maintained that you want to own less healthcare because I think there's a major bear market coming. I don't think interest rates are going to keep going up much longer because either the Fed backs off or we have a problem. And then interest rates come down for that. So one way or another, the bank's run is almost done. Either the Fed screws it up or the Fed backs up. It doesn't matter. Either interest rates, the long-term treasury, the 10-year treasury is not going to be over 3% during the next recession. And we know that the next recession is coming. And in fact, I would bet that we see 2% on the 10-year treasury before we see 4%. Why? Because we're already seeing growth slow down. We got the China numbers yesterday or late last night or something. And China had the slowest growth that they've had in a while. That's going to affect everybody. I was just listening to an analyst from, was it HSBC? I forget who it was, but they estimated that global trade could fall up to 17% in the next 2 years if this continues to go the direction it's going with the trade war. 17%. Okay, so the United States might end up with a fraction of 1% bigger slice of the global pie, economic pie. But if the global economic pie shrinks, how has it helped us? So, you know what the easiest way to get more of this pie is? Come on. Somebody say it on the chat. What's the easiest way to get more of a pie? Try to take somebody else's slice, right? Or make a bigger damn pie. That's right. Make a bigger pie. So we're having a problem with growth because our policies are not designed for growth. Our policies are designed to take a bigger slice of the pie. That is part of the personality of the president. Just is. That's what he grew up with. That's what he believes. He believes you take a bigger slice of the pie. He has no macro concept of the economy. Zero, none, nada, zilch, nothing. And that's a major, major problem because the pie is going to shrink. Now, I'm not saying don't play tough with China. But when you alienate your allies to the point where they'll trade with China and create a financial vehicle to do business with Iran, when we're trying to confront those two countries, if your allies aren't on your side, you're screwed. And that's where we stand right now. And we're not going to be able to coerce them. Maybe we can coerce Saudi Arabia a little bit here. I don't know how that standoff goes. Trump wants to sell them weapons, but we want to keep the petrodollar. But they're killing, somebody with United States residency. I mean, it's pretty clear that they killed Khashoggi. And I'm not saying he was a saint, but I'm just saying that, it's not really something you should do, just, order executions. So whether Prince MBS ordered that execution or it came from people who don't like MBS and they're trying to make him look bad, doesn't matter. Saudi Arabia is starting to spin out of control. There was an assassination attempt. They got no press. I mean, it just blows my mind. So how does this all impact the economy and the investments, right? That's what we have to try to figure out as investors. What do all these moving parts mean? It means that in the short term, things can be manipulated a bit. But in the long term, everything plays out. And in the long term, we're going to have to deal with slow growth forever. The only way to offset it is through rebuilding the economy in a more sustainable fashion. This trying to get more slice of the pie is just not going to work if we shrink the pie. How do you grow the pie? You replace, right? Planned obsolescence, replacement. We don't need more coal. We don't need more oil, right? What we need is more solar, more alternative energy, more technology, more AI, more VR, more AR. We need all these things to push the economy forward and cause us to build more stuff. We have to replace stuff. We don't want to try to milk it out. If you've ever noticed, I have this experience in Milwaukee because we have way too many bars. I think we have the most bars per capita of any big city, of any city, 100,000 plus. There's bar owners all over the area here who, yes, Obama's policies were designed for growth, but this guy named Mitchell in the Senate who didn't allow anything to get passed for 6 years, he kind of put a damper on that. Because if you notice, the economy was coming out of a depression, and I'm tired of this argument. Anybody who doesn't think that the Federal Reserve and shovel ready and everything else that was done in the first 2 years of President Obama's presidency didn't set up the economy to grow for the last decade is wrong. And I have actually meaner words for this. When you block policy for 6 years, right? When you don't pass anything for 6 years, when you take 17 zillion votes to repeal Obamacare before it even starts, and in hindsight, Obamacare is pretty mediocre, but this idea, Obama, baloney. It's just like blaming Jimmy Carter, and I forget the name of the act, for the housing crisis. The housing crisis was born of a 1999 change in the law that allowed the consolidations and the futures and to change. It was a bad deal by Clinton with the Republican Congress. They both screwed up. And by 2008, on top of vast deregulation, loose money, fraud, and a whole set of synthetic derivatives, and then ratings agencies that basically lied to get fees and calling things AAA, it was a perfect storm. But people try to say, well, if President Carter hadn't, said that the banks have to treat people fair. Then we went to had a crisis. Think about how stupid that is. Just remarkably stupid. President Carter wants to get rid of redlining, and that caused the crisis. So dumb. So yes, President Obama's policies were designed for growth. Clearly, he's a capitalist. These people who run around calling President Obama or Hillary Clinton socialists, just so freaking dumb. Now, if you want to say that their policies are bad because they're not well thought out, fine. I think you can make some pretty damn good cases. But for 6 years, Mitch McConnell didn't allow President Obama to pass anything. And yet the economy still grew, even though it was coming off a depression-style event. Come on, get over it, right? This is why I get so pissed off about people railing about their ideology and self-rationalizing, self-validating for to rationalize, to self-validate. It's garbage, and we have to get over it. There's an article out there right now. I forget who wrote it. It talked about Mitch McConnell, and I will say this to the people of Kentucky. I know I have a few members. I don't know why the hell you keep reelecting that guy. Has he really been good for Kentucky? He sure hasn't. I've been to Kentucky. Pennsylvania, same thing. I understand why people in Pennsylvania voted for President Trump. I do. The economy passed them over. This is one of the failures of Obama, but also of Mitch McConnell. You have a lot of blue states that went red, not because they're suddenly more conservative. They've always been kind of middle of the road. I spend lots of time in these states. It's because they felt passed over, right? They felt like the economy is starting to grow and nobody helped us get our jobs back. And nobody's helping us take care of our families. And we're losing homes, and our kids are falling through the cracks, and I'm angry and pissed off about it, right? I get all that. Clearly failures of both a Democratic president and a Republican Congress. And so anybody who takes either side on a consistent basis is missing the point. Both parties suck. They just suck at different things. And we have to try to fix them somehow. And that means we have to find more pragmatic approaches, and we're just not doing it. So again, I don't care if I offend anybody. If you haven't noticed that, I don't care if I offend you. I want you to think about this, because in the end, it affects how you invest. So I have to split my world into, I think this, and this are right, but I see this, and this happening, so how do I invest based on it? And then I have to reconcile that with, eventually, this is Winston Churchill, eventually we will get it right, because the Americans always get it right after they've tried everything else. So eventually we'll figure things out. And this idea that we're not Machiavellian, that we're not predatory, that we don't steal technology, that we don't instigate wars, right? We're talking about not punishing the Saudi Arabians. We're trying to give them a way out so that we can sell them weapons. You know what? Maybe we should just let those stocks drop 30% and cancel the weapons deal. Right? I said it. Maybe those companies shouldn't. Jax, you can unsubscribe. I don't give a shit. My soapbox. I've been involved in so many things in the last 30 years that I can speak with some authority about a lot of these things. I spend time with Republican strategists. I grew up with Democrats, and I'm just telling you, both sides have major, major weaknesses. And if you're hanging on to one side or the other, you are missing it. Maybe you get some benefit from that personally, because they steer you money. But the reality is that we need entrepreneurship, we need smart regulation, we need progressive taxation, we need all of this other stuff. No, Mosey, shut up. Seriously, Mosey, shut up. Do I always bring it back to investments? I do always bring it back to investments. And why do I do that? Because if you don't understand these big trends and how the government and each party is steering things, you're going to miss it. So what's going to happen in November? In November, the Democrats are probably going to take the House of Representatives. They might take the Senate. And then we get gridlock again. Is that good or bad? Is it good or bad at this point? Right? I know I'm stirring up a hornet's nest on purpose. So we're going to have to adjust. And once these buybacks are over with in 2 or 3 months, we are screwed. We're screwed. So we have a trade to make right now. And the trade to make right now is to get very long this market. Why? Because it might be the last money you make for a while. The anticipated rate of return over the next 7 years, according to GMO, Grantham, is negative 7% in the United States. That's how overvalued we are. And if we tighten, if the Federal Reserve tightens and trade shrinks the global economy, the stock market will turn over at some point. I'd be looking at the top of this market being in the first quarter. That would be my guess. Could be a little later. I'm not sure exactly how long the buybacks can stretch out, but most of these companies are going to be in trouble, right? So we did the worksheet. Put long-term debt and net debt issuance. So you have companies out there that are buying back stock. Apple's an exception because they're sitting on trillions of dollars. But when you go down here, take a look at the net debt issuance. Look at all these companies that are buying back stock, but they're issuing debt at progressively higher interest rates. What happens when it's harder for them to refinance? What happens? It means these companies have a problem. There are all sorts of companies here that are buying back stock that are going to have horrible crashes in the next couple of years. Figure out which ones they are. Right? Now, I'm in AT&T, but they issued a ton of debt. However, they bought Time Warner. That's different. But you take a look at some of these other companies and you say, okay, Anthem. Anthem is buying back stock, but they're issuing debt. What happens if the government decides to start cracking down on the extremely expensive costs in healthcare? Right? President Trump's actually pretty good about that. So it's not like I don't say good things about President Trump or the Republicans or Democrats. I'm just pointing out that all the ideology, the things that they use to get your vote, are stupid, manipulative, and counterproductive. And we have got to change that in November. I don't care who you vote for. I really don't. Vote for a Republican, vote for a Democrat. I don't care. But vote for somebody who's not just saying, I'm conservative, I'm liberal. They're racist. Right? They're for the rich. Figure it out. Because we voted very stupidly in most of my adult life. And actually, since I've been a kid. We've been horrible. Only half of us vote, and we don't have any freaking idea what we're voting for. We vote based on emotions. And that's 4 out of 5 people. It's 4 out of 5 people. And it affects this. It affects how we have. This is all about capitalism, right? If we ruin capitalism because we're so stupid with the way that we vote, we cause these crashes ourselves. And then we blame somebody else. It was the banks. It was the ratings agencies. Yeah, kind of. But we voted for the jerks that regulate them. I'm trying to sound a warning here. And I did it in 1999. I was told I was stupid, that everything was different this time. And I was given seminars, and I spent my own money until I started putting it on mutual fund companies to buy stakes for people and tell them that we were going to get a crash from late 2006 to, I think it was late 2007. Told everybody. I explained to them why. I'm explaining to you why. We're doing things wrong at the Fed level. We're doing things wrong on regulation, especially the environmental stuff. We're doing things wrong with trade, and it's all going to be a problem. I don't know how fast that happens. I'm guessing 2020. Because, and here's the linchpin, President Xi in China doesn't have any political pressure. He can take the United States down. And he's going to. I'm telling you right now that if we don't see a real deal with China, and there's a deal to be had, I just don't know that it can be made anymore. So we should pray that there's a resolution to China's very, very soon, like by January. Otherwise, next year is going to tip over. So there you go. That's why a lot of these things happen. Now, you just want to talk about the fundamentals of stocks? Fine. That's not our process. Our process is the core four. Take a look at the big trends. Take a look how government and central banks affect things. What have I been talking about? I've been talking about the big trends, how the central banks and governments affect things. You don't want to hear about it if you then you're a bad investor. Period. You're a bad investor. So we need to be aware of this. As far as how the buybacks are going to work, again, we don't know exactly how fast these companies are going to spend money. So here's my cynical take. I think the CEOs and the executives who are selling stock into the buybacks, right? They're selling their own stock that they got from their options and whatnot into the corporate buybacks. They make more money and they get another bonus at the end of the year if stock prices are high. So they don't all operate on the calendar year, right? A lot of them have different fiscal years. So there's different incentives for different CEOs. But, and that actually would be good research, is to find out which companies with buybacks when their fiscal years end, because that'll be the time frame that they are buying back stock through that fiscal year end. Next 2 months are going to be spectacular, I think. I think we're going to get a huge Santa Claus rally because all this stuff that everybody's fretting about will be gone for a little while, right? Be gone for a little bit while. I think the Saudis are going to have to play nice for a little while, but eventually that flares up again. Iran is pretty effectively stopped the bleeding, right? They're still selling some of their oil. They have to do it through different vehicles, different ways. Is there about 1 million barrels off the global market? Yeah. And you know what? Someday it comes back. But by then, other oil will be gone. So this is probably the reality. I think we get a big rally in December, November, December. I think it probably goes into January because that's when all the retirement plan money comes in. February and March probably are fine. But in April, I would be worried about April. Now, can we predict that future? No. But what does that mean? On the dips, we should sell a ton of puts, and we should buy a bunch of stock. And then when this market runs up again, our puts should mostly expire, and we're going to have to figure out what stocks to take profits on. And I think it'll be anything speculative. When we finally get this last oil stock rally, and I do believe oil stocks are going to catch up to oil soon because their earnings should be pretty darn good the next 2 quarters. It doesn't really matter what oil does anymore as long as it doesn't crash, right? If oil doesn't crash, the oil stocks make money, and if it doesn't spike, the economy stays good. Until, of course, trade problems and liquidity problems. So we need to take a look at these stocks on this worksheet that we have and say, what do we want to buy? Well, I'll tell you what. If you don't own Google, and I say this to myself because for a while I didn't own Google, then you're not paying attention. Google is a stock to own. So is it going to get all the way down to $1,000 a share again, give or take? I don't know. I sure wish it would, but I'm not so positive. And we're within about a week of maybe 2 weeks of the stock market starting to surge again. So, you should probably own a couple shares of Google. Amazon. Is Amazon even on this list? I don't think they buy back stock. No, they don't even have any buybacks. They're just becoming profitable. But Amazon, I think, is a stock that we should be looking at finally. I don't know that they're going to get back down to 1,600-ish, which is what I was looking for. But if they did, you'd want to back up the truck. And I think that Amazon probably continues to have a very bright future. The more I look into their company, the more I think that they could end up being 3 companies if they end up getting any pressure from the government. Until that time happens, they don't have to do it. But Amazon is, frankly, I missed the boat on them, and I'm amazed. So the more I learn about them, the more I wish I had figured it out 6, 7, 8 years ago. That would have been just a great holding, And something that Jeff Bezos said in an interview recently makes sense to me. And it's that he goes, we had the luxury of nobody stepped up to compete with us for a very long time. And now, who's competing with them? Well, companies are doing it on their own. Shopify has been a big beneficiary of that, but that stock ran up too high. So we've laid off of that. We nibbled in one time. I think we traded it. Um, we have to look at, on this list, what are the very best companies? And I think that what you would want to do is very simple screen, right? What's a very simple screen? Price to book. Look at some of these companies. Price to book values under 2, around 2 or less. That's pretty darn good. So who can you take a look at? I don't know. Again, stay away from the banks. Here's a company that we've been looking at. Right, we've been talking about this one this week, Dow DuPont. Look at this, AT&T. We own AT&T. I actually looked at Fifth Bank Corp this week. I'm gonna look into them more. If I'm gonna own a bank, I want a regional. And I'll tell you what, Ohio. I believe they're out of Cincinnati. I have to double check. I don't really know. But if they're Ohio, I like Ohio. Hewlett Packard Enterprise we played with a while back. Lowe's, I think Lowe's on the dip. One of the things that we're going to take a look at, I think, when the next recession happens, we're going to want to just buy the heck out of building stocks. Because there's no way the United States grows its economy without a lot more immigrants in the next decade. So at some point, we loosen up on immigration again, and then a lot of people need houses. It's hard to find builders right now. It's a very tight market for subcontractors. Hess, Hess is a company that's kind of been in and out of our radar. Somebody asked about Valero today. I don't want the refiners. I just don't want the refiners. I think that they have so much capital spending. It's unbelievable. I looked at Caesars last week, and then they, there's talks about a merger. I think Caesars, I'm a Vegas guy. I think Caesars is the best casino group out there. But MGM, if they got their stuff together, would be pretty good. The thing is, Caesars went through a bankruptcy, and they were able to do very well with restructuring their debt. So, Caesars is a new idea that I'm taking a look at. But I really don't want these refiners. Schlumberger, Schlumberger, if you want a service company, you probably take a look at them. They're paying debt down. They pay a dividend. They're a leader in the industry. The problem is that you have time frame issues with all the energy companies. By the NASDAQ. I think Anthem's going to crash. Right, so you go through this and you try to figure out who's out there. People ask me about Walgreens. Here's the problem with Walgreens. Did you know that Realty? Which REIT is it? Is it? I forget which REIT it is. One of the REITs out there own like 70% of the Walgreens. So Walgreens doesn't really own a lot of their own real estate anymore. That's not good. I think Walgreens has a problem. I think more and more drugs get delivered online. I think margins shrink. And really, how many of you go to a convenience store because it's convenient? Nah, and nobody does it anymore. Whirlpool is a company that I just started looking at. Why? So Whirlpool is getting beat up because Sears is one of their creditors, and people just don't like the industry. But when you take a look at them, you start to see, basically they have bought back stock almost in line with what they've borrowed. But I think that Whirlpool, if they manage it right, and we have to watch the execution here, I think Whirlpool is something to keep an eye on because, as I've suggested to them, just by tweet, but I think that Whirlpool should try to get a hold of Sears into bankruptcy and do the supercenter thing, and then put their brands in Sears and start working into the smart home future. You set it up kind of like Home Depot where you have contractors and the retail side. Norfolk Southern all of a sudden is starting to get kind of cheap. Intel's a stock that I tell people for a dividend growth stock, you should be keeping an eye on it. I don't like the airlines anymore. I think that they have some. I think their cycle is over. Disney is a company that it never quite comes back to what I want it to come back to, but I think that they could take major share from Netflix. Skyworks Solution is kind of part of that. I don't like Walmart. Procter and Gamble, I think, not a sexy stock, but suddenly pretty interesting at these prices. So you go through the list, and when Cisco is something that we've got through the telecom ETF and through the communications ETF. I think it's actually a stock that, if you just wanted a blue chipper, buy Cisco on a dip if you want a dividend growth stock. So you go through all these. Facebook, I said, was going to have hard times, and it has. Caterpillar, I think, is coming down hard. Merck for sure. Johnson Johnson, range bound. PayPal, we've been buying up. So you go PayPal. They've only been public a year and a half, and they're buying back shares already, and they're expanding rapidly, right? So they're issuing debt, but at the same time, you got to remember, you have to really analyze their international business. They could grow 20-fold in the next 10 years, right? And they're going to get in they're going to end up becoming a cryptocurrency exchange. Mark my words, right? So yeah, and I've traded it. The shares I have now, I'm going to hold a long time. Here's an interesting company, Expeditors International of Washington. Oops, I didn't mean to do that. Interesting company. Not issuing any debt, still buying back some shares. Transportation is going to continue to be tight. I think Expeditors could do well, so it becomes a matter of valuation. Right? Now we're getting up into these higher book values. And then a lot of this stuff doesn't make sense at these book values, right? Buy the whole damn company. And some of these are not listed properly. They don't have the data's not in there. But right, some of these they don't make sense. The price to book value just doesn't make sense. And when you see numbers like this, you have to take a step back and do some sort of a different calculation, because probably these numbers don't truly represent what's going on, right? Like with MasterCard, you have to figure out the financial aspects. Visa's probably in the same area. Yeah, there you go, Visa. So some of these companies have artificially high price to book because certain things don't get counted. All right, I'm done yelling at you. All right. No, what did Avi say? Avi thinks there's going to be a rally now? I think the S&P 500 is going to go to about 3,300-ish by Q1. So that's a good reason to be in there. Focus on the companies with buybacks. The easiest way to do it is QQQ. Yeah, Couch posts a lot of things. The guy who did the article on the buybacks from Micron, his assumptions about how they're going to do it was just so wrong. I mean, he might be right, but he'd be lucky. That's probably not how they're going to do it. Micron shares probably have a floor under them because of the buybacks. And then what will drive them higher is what I believe to be fact, but we don't know until it happens, right? Is I don't think the down cycle in semiconductors will be that strong. So in that article, the guy references a weaker demand for PCs. We've known that for a long time. The real thing that's going on isn't weaker demand for PCs. He says, well, there's less PCs being sold. That's not a demand issue. It's actually a supply issue because Intel didn't have the processors. So there's a pent-up demand for PCs and servers right now because Intel couldn't supply the market with a piece. What does that mean? That means that there's a little bit of lull. People are extrapolating it out, and they shouldn't be. What it means is there's going to be a rebound. So somebody posted privately, do you acknowledge that Trump's hard line is a negotiating tactic, not an endgame? No, I don't. I do not believe that one bit. I think that he's trying to change certain things. And he goes, we have now amended fence with Canada and Mexico. Not really. No, they're still both pissed off at us. And the new NAFTA, you might as well just call it the new NAFTA, is not hardly any different at all from the old NAFTA. He did a couple things politically that could get him votes, but the new agreements really, it just shuffled the deck chairs a little bit, but not really much. It's not really basically any type of new agreement. I mean, Trudeau's up there shaking his head. The Mexicans are down there going, "What the hell?" You know. Um, no, I don't believe that his methodology is effective. I think that it's ignorant on a lot of levels, and I think that that's dangerous. I know that people want to believe because they voted for him, or you recognize the problems. Um, but the reality, I think, is that it's a slice of the pie issue versus growing the pie larger. And right now, we're going for a minuscule slice of the pie, the claim that we got more pie, even though the pie is going to shrink. That's a major problem. And yeah, sure, China must be dealt with, but why didn't we keep the Trans-Pacific Partnership? That's what it was designed for, to deal with China. Why didn't we cut a deal with the Europeans and say, hey, let's fix this technology issue. We all need to have a united front against them, and then they'll have to cut a deal. Right now, Xi can just wait out Trump. Uh, no, I don't think that same guy, the Saudi deal isn't just about weapons. It's about geopolitical balance versus Iran. No, I mean, okay, so I wrote a paper, I helped write and edit a paper um, of my own after I was on the think tank team back in college about Iran and policy there. Look, it's all about getting rid of the Ayatollah. The reason we did the nuclear deal was to wait him out, figuring he would die. He just hasn't died yet. He's going to die eventually. When he finally dies, the people are going to step up, and we need to support them. And Trump is signaling that we want to support them. The thing is, he didn't need to do what he needed to do. I actually like the pressure on Iran. I like that he put sanctions back on them because it gives the people, it stirs them up, right? And the thing is they're pretty smart over there in Iran. You run the risk of them turning on us, and that's a problem because the Iranian people are very largely, except for the demonstrators, pretty pro-American. All right, we talked about DuPont, we talked about VLO. Yes, buyback surge. So somebody asked me about selling puts in Occidental. I would just buy the stock. Pioneer. I don't know. I haven't looked at it this week. Oh. All right, so let's talk a little bit about oil. This trend here, right, even though the price of oil went up, has not been very good. At some point, you have to think that the oil stocks start to reflect what oil did. So let's take a look at USO on a fundamental chart and then put XOP on it. Normalize it. Last 3 years. About a 5% gap. Oh, look, oil actually hasn't done, oil stocks, that divergence has kind of gone away, hasn't it? So now we just have to see the earnings drop to the bottom line. Yeah. Yeah, oil has outpaced oil stocks by 20% in the last year. That's the gap that you would expect to close. But when you look at it over a longer time frame, 15 points there, but it's the other way. 3 years, pretty similar. 1 year, right? Pick your divergence. My argument on oil stocks is this. The best ones, the ones that have the cheapest oil, the ones that don't have a lot of legacy debt, right? For the short run, it was about the ones that were not hedged, Continental Resources. I think that those companies are going to see a lot of money fall to the bottom line. Now, here's my problem with Continental Resources is I don't trust Harold Hamm. Harold Hamm screwed up on his hedges a few years ago, and what he should be doing, and we should double check here that he's doing it. He probably Fifth Third is out of Cincinnati, New Ohio. We should make sure that he's locking in some of these $60 and $70 prices, right? Like the rig portfolio was a joke, um, but if you like it, I don't care if we use it. Raytheon, I think, is expensive. Lockheed, I mean, I tell you what, I made a mistake a few years ago. I should have bought Lockheed Martin. Love Lockheed Martin. I think that AT&T is a great holding. I try to be in that 3 to 4% holding, per share. 3 to 4% of portfolio in any one stock. Could you go a little heavier in AT&T? If you're a retiree or near retiree and you're cool with that dividend, and you think the kicker is that maybe they move into a higher trading range because of 5G and advertising and content, yeah, you go a little higher. Yeah, so Avi Gilbert and I both wrote for Market Watch, and I pay attention to him because he's a pretty good technical guy. Um, he truly doesn't care about fundamentals. Doesn't care. He'll tell you flat out. Doesn't care. So I do care about fundamentals because I think ultimately that drives everything else. It's just you have to figure out the time frames, and that's what he's doing is figuring out the time frames. I think the market is topping. I just said that. I think by first quarter it's probably topping, maybe a little later than that. I think we get to around 3,300 on the S&P 500. And if the Fed is still tightening and trade starts to put in problems, we got problems. So we have to be careful about all of this. We have to stick with the stocks that have differentiating factors where they're not going to be completely dependent on the overall economy or the overall stock market, but they can make money because of what's going on in their industry and with their business. Calix is one of those companies. Yes, I do think you can sell more puts on Calix, and I like the idea of just owning the stock. I do own some of the stock. Yeah, the new NAFTA doesn't actually do that though. It's not veto power. They can still cut other deals. The United States, they're supposed to consider the United States, and the United States is supposed to get input. We can't tell Canada and Mexico not to cut other deals. So I know that's what's been reported by a couple outlets, but that's not what it says. Window dressing for American voters? Yeah, quite possibly. ECA is down to 11/28. Yeah, if you don't own 3 or 4% in ECA, I think you can do it. This is one of the few leaps that I think you can buy right now. AT&T has atrocious customer service. Well, here's the thing. It's actually better than it used to be, kind of because of Spring Mobile, which is GameStop. But you tell me a telecom company or a cable company that you say, oh man, I love talking to them. It used to be DirecTV. You used to love talking to them. They always cut you a deal. Yeah, we understand. Sure, we'll give you another year cheap. So I don't think it matters. I mean, would it be better if they had better customer service? Sure. But they've sucked for a long time. They've all sucked for a long time on customer service. And the reality is they don't have a lot of flexibility. What's a customer service person at AT&T or Spectrum or Charter or Comcast or Verizon going to say to you when they're said, this is the range of things that you can tell people? You argue with them, you cry to them, say, give me this, give me that, do this for me. And they're like, these are the tools I have. I'll be real honest. I think as consumers, we're pretty freaking spoiled. And, we have to understand when somebody can and can't do something for us. And it's not always that they don't want to or they're jerks. Sometimes they just can't. Yeah, somebody else posted all telcos have crappy service. Right. I love accidental. Okay. So Couch gets mad at me for this, but I do not give, and some people have quit the service. I do not give you my entire analysis. I give you kind of bullet points. I take you to the water. You need to do your own due diligence. Why? Because the research that I do is institutional level. And I can sell it for $10,000, $20,000, $30,000 a pop when I do a complete report. You guys are paying a few $100. You're going to get what I do generally the day after I do it, right? Because if I'm buying at the end of the day, I have to tell you that night. But, I give you lots of limit orders, and those are the same limit orders that I use. If I tweak it, you maybe figure out after the fact. Here's the thing with accidental. We'll finish on that. They were smart enough to sell their export terminal and some of their midstream. What did I say just a couple weeks before they did that? I said that midstream is fully valued and that smart companies would sell it. And then accidental 2 weeks later did it. The United States uses 17, 18 million barrels of a day of oil. We produce about 11 million. We're not really supposed to be an oil exporter. But here's where you have to take a look at Saudi Arabia and take a look at OPEC. And I'll actually, if I can get it up quickly, EIA imports oil by, there we go. Okay. So we have gross, is this right? All right. Yeah, that looks right. So there's swapping of oil, right? Persian Gulf countries, 1.73 million barrels of imports. We can replace that with Canada and Mexico in the next few years, right? We need a pipeline with Canada. We're building all kinds of pipelines with Mexico. If we want to pull the plug on the Middle East, we can. And I believe that's actually what is going to happen. I think that by the early 2020s, you see the United States completely pull out of the Middle East. We're just going to tell them we don't need you. We're tired of it. We're going to sell you all the weapons you want. Figure it out yourselves. That's what's coming. Now, I actually believe there's a possibility that we have to defend Iran at some point in the 2020s. How weird is that? So, President Trump could have a big pullback. I've already told you what I think the response is going to be. I think he's going to say pay for the weapons up front, put more of a crackdown on Wahhabism, give us some heads for Khashoggi, and you're on, super secret double probation. That's what I think is going to happen. And by the way, keep the petrodollar for a few more years. And honestly, I don't know that President Trump cares about the petrodollar. This would be a way for him to get rid of the petrodollar and decrease the value of the dollar, which is what he wants. He can't get it from the Fed. He can go around them. What if he tells the Saudis, you know what? Here would be a brilliant move by President Trump. If he does it, awesome. Cut a deal with the Chinese and the Saudis. Say, here's the deal. Saudi Arabia, we're going to slowly start getting out in the Middle East. We're going to sell you all these weapons. Go ahead and start selling oil to the Chinese in yuan. China, we're going to tell Saudi Arabia to do that. You buy some natural gas from us and pay our technology companies a fair price for the technology that you want. And then go ahead and produce whatever you want. Just make sure that we have access to your market. Pay a fair price, give us access. We'll help you internationalize the yuan. Right? There's a deal to be had there. But when you're banging heads and being a cock off on Twitter, it doesn't always happen because you know what? All those people are proud and they all got egos. Oh, go Dodgers. Boo. I don't have a problem with any Dodger except Manny. Manny Machado should have been suspended. He should have been kicked out of a game. He should have been suspended. But in any case, the Brewers are going to win both games by 5 runs or more, and Manny Machado will get dusted. How's that for a prediction? In any case, I do like Occidental here. They kept their plastics plant. I think that's going to be a big deal. And their their carbon capture. I don't know if they're doing, are they sequestering, or I don't know the exact term for what they're doing, but basically they have, carbon capture technology. And what we just learned is we better start capturing our carbon and our methane quickly, or we're in big, big trouble. These storms that we're having were written about 12 or 14 years ago, right? Storms of my grandchildren. These storms were predicted by the guy from NASA years ago. 2010, 8 years ago. I think the book's older than that. I think that's just the paperback. But, James Hansen, he talked about this. This is not something that wasn't predictable. These storms are becoming more violent, and NASA's known it for a while. He started telling Congress this in the 1980s. This is not a sudden thing. Remember, I've told you over and over again, things happen slowly until they happen suddenly. Climate change policy is going to change very suddenly come 2021, 2022. Why? Because there's enough people who are going to vote against the Republicans, unless President Trump really becomes a dynamite at crossing the aisle, not only in a couple weeks, but in 2020. And I know that Harold/Dave, who is on the service, sees a whole different awakening coming. I don't. I think the world's becoming more secular, and I think it needs to become more secular. I think that religion needs to stay indoors, right? Part of Harold's family. I mean, I have missionaries in my family too. But this whole ideological warfare, the stirring of religion, the claiming the extreme edges, it's actually going to start going away. That's my prediction. And I think that we're going to start working very good on a sustainable economy in the 2020s. I think it's going to be a major, major theme. I've been waiting my whole adult life to be able to say that. So it's not like I'm part of some cult of environmentalism. I'm a tree hugger, but I've been an oil analyst. I've been an oil analyst, So I made a lot of money on that too. But I think that you're probably going. Yeah, I know you're not Harold. I know Dave on this board is not Harold. His is David, and I only see that in his emails. But I think that when we look at stocks and we look at the trends, we have to stick with understanding what the big secular trends are. The government and the central banks can change the timelines. What should be happening right now isn't happening. Will it happen? It will. Will it probably happen after we have a kick in the gut? Probably. So in the next several months, you have a very good trade. You could even, and I hate to talk about that on this service, but you could even swing trade this. You could buy QQQ calls. Buy QQQ calls to like April, which gives you some time value, and then sell them in January. And you might make a pretty good hunk of money. You could try to buy some calls on Google, on Amazon. A lot of these companies that do well. One of the truths of the market is that stocks that have done well generally continue to do well until they hit a brick wall. I don't see Amazon hitting a brick wall anytime soon, or Google. I think Facebook is trying to figure out how to climb their brick wall right now. Will they be able to do it? I don't know. I don't know how sick of Facebook people are getting yet. I'm up and down on it. I do think that Zuckerberg is a jerk of an Elon Musk variety. I think he's a jerk too. But they're smart guys. Elon Musk is brilliant, actually. but he's, kind of a jerk. And Zuckerberg, he's more of a thief, right? He's a decent programmer, but he's really nothing special. He found somebody else's idea and improved it. That's less than what Bill Gates did. Bill Gates was smart enough to buy some technology from Xerox, I think it was. So when you take a look at this, the oil, the technology, the big trends, the government impact, the fundamentals of stocks. Here's something that you should know about the fundamentals of 2/3 of the stocks in the S&P 500. Not that good. People can say all they want. This is the best corporate balance sheets have looked. But it's because they've been spending money on buying back shares. They haven't paid down enough of their debt. If interest rates really go up, they're in trouble. And we know that with slow growth forever, most companies in the old economy, talked about this as well in an interview, most stocks in the old economy are going to have a hard time. So you better get really, really good value and some income. That's what makes it hard to be a dividend growth investor, is most people are overpaying for dividend growth. And here's the other thing. If the Fed really does keep raising interest rates, and it seems like they're going to, REITs are going to get slammed. So all these folks on Seeking Alpha are talking about buy this REIT and buy that REIT and buy the other REIT. It's a problem. Oh, it's got a 7% payout. It's got an 8% dividend. Yeah. What happens when the stock price drops 50%? And you got to wait 10 years for it to come back. Just understand that's part of the game if you're going to do it. What happens if they can't finance their dividend anymore because a third of their renters disappear during a big recession? The idea that 2008 can't happen again is wrong. It can. We don't know what the response is going to be. I think it's going to be helicopter money, and I do think it works out. But you have to consider those risks for your asset allocation and your financial plans. What if there's another 2008 to 2011 period? How does that affect you? What does that do for your income? What does that do for your retirement plans? If you're a growth investor, take a look at the very long trends. I have 20-something-year-olds and 30-something-year-olds telling me that they want to do growth and income investing. What does that mean, I ask them? Well, I want stocks with dividends. Okay. Do you want stocks that don't grow, or do you want stocks that grow? Well, I just want the dividends. They don't know what they're doing. If you don't have a growth rate with a dividend growth stock, it's not really going to do anything for you long term, because growth matters. You need to be with the winning companies. And that's why QQQ, if you're going to do an ETF, is the easiest one to do, because it beats everything else over and over and over again against multiple time frames, even including the tech wreck, right? So if we take a look at QQQ, we compare it to SPY, and we do total return price, get rid of price, normalize it, and go back to the max. Why is that there? On QQQ. Here we go. Even with the tech wreck, QQQ has outperformed SPY. You pick out just about any time frame. Pick out 10 years. QQQ crushed it. 5 years, crushed it. 3 years, I think this is the one where they're still beat it. In the last year, beat it. You're much better off with QQQ. They're better companies. They're more involved with the new economy. They have better balance sheets. They have better growth rates than Spider. Spider has a 1% better dividend. How do you feel about that 1% dividend? Yay, or last 10 years you would have made just a little. Well, no, this is total return. Right? Nobody should own SPY. Own QQQ instead. Well, okay, so Dave says Visa and MasterCard, best long-term growth. I think they're great companies. I think they're always expensive. So they'd have to come back for me quite a bit. I like PayPal. I think PayPal is going to join this group, and they have a whole lot of room to go before they get there. PayPal, like I said, I think PayPal is probably going to have a crypto exchange too. And I'm not a big cryptocurrency guy. I think cryptocurrency plays into the whole inflation, deflation thing the wrong way. But whatever. Wait for a little buyback on PayPal, sell puts maybe if you want. Competition is going to nip them. Are you talking about Visa and MasterCard? Or are you talking about PayPal? Yes, Visa, MasterCard. Yeah, yeah. I think PayPal is a big deal, and Venmo, and they're doing their own credit cards. I mean, at some point they get less fees, right? At some point, Visa and MasterCard cannot maintain their pricing on the fees they collect. You already seen it happen. Square, right? You're seeing it happen. So there's probably a banking crisis in Europe coming in the early 2020s because the zero interest rate environment lets companies survive that would go and bust. Yeah. Well, I understand that. Yeah, I use PayPal nonstop. I pay for my poker entries with it. The idea that Europe can maintain what they're doing without more integration or with at least some sort of fiscal changes is probably true. So I had a professor back in 1993 who told us that the euro will fail because they're not going to go all the way with it and because the Germans believe in austerity. And that's exactly what's happened. So ultimately, the Italian budget is fine, right? Because if they really were on their own, they could do what they're doing and they'd be fine, and the market would control it. But now you got Germans trying to control it, and it's just a bad deal. That's why the Brits are, that's why there was enough support for Brexit to sneak it through on that one vote. Now, in hindsight, should Brexit happen? I don't know. I really don't know. I actually think that they all need the euro because they need the stronger currency. But at the same time, they have such a horrible way of handling the fiscal side, country to country, because all their economies are different. They have to get over that, and I don't think that they will. Mobile payments, Apple Pay, Samsung Pay. Yeah, I do agree they'll be using their phones to make payments, but the money will still be at PayPal or somewhere, right? And there's this belief by the millennials that the big tech companies will open banks, but remember, regulation. So you have to figure that out. So in the 401ks right now, I do think that you should just do the best you can to get, over the next couple of weeks to get into equities. If you have something that's akin to a large cap growth that you can look inside the holdings, and it's a lot of the QQQ, that's what you do. But I just don't think that you're going to get a lot of play out of the S&P relative to the QQQ, but it might be the best you can do in a 401k. And that's just the way it is. So I think that most people who have been holding 25% or more in cash need to get that, and I'm going to update that this weekend. I think you need to get your asset allocations to about 10% cash. Why 10%? I have a hard time going under 10% unless there's a crash. And there hasn't been. There's just been a little choppiness. But these buybacks are a big deal. Anybody else, or can we call it a day? Go Dodgers. Good grief. Go Brewers. I'm sticking with Brewers are going to win both games by over 5 runs, and Manny gets dusted. All right. Guys, have a great time. Sorry for yelling at you, but I'm sick of us screwing up the same ways over and over and over again. Stop screwing up the same ways.